Welcome to Girard's Monthly Market Update. I'm Jim Jacobson, Senior Vice President, and this is Tim Chubb, our Chief Investment Officer. Thank you for joining us today. So Tim, since we last talked, we've had quite a bit of action in the market, and just as a recap for where we are year to date, the stock and bond markets have performed quite strongly. The market was off a little bit Friday with some yield curve updates, what we'll talk about shortly. But first, let's just recap where the markets are year to date. The S&P is off to a very strong start, up 12.26% through last Friday, and the NASDAQ even stronger, up 15.5%. The small cap index up almost 12%, and overseas, this might be surprising to people, both the EFA developed markets and the emerging markets index are up almost 11% year to date after a very difficult year last year. Perhaps the most surprising indexes of all, though, are coming from the bond areas. Bonds are not known to be real exciting, but so far this year they have delivered quite strong returns. We have the Barclays Ag up 2.6%, and the Muni Index up 2.57%. And strongest of all this year is the junk bond index, the high yield index, also known as junk bonds, up nearly 7% through last Friday. So let's get into what happened last week with the Federal Reserve. I know they had a meeting Wednesday, and there seemed to be a little bit of action, and then Friday a little bit more took place. So tell us.
Friday was really where we saw some market gyration coming out of getting some data overseas, particularly in the European region, from a growth perspective, and continuing to see growth weaken there. But last Wednesday was a bit of a continuation of this dovish view from the Fed. Really, January, February, they've taken this view that really the whole Phillips curve being that wage growth will drive inflation, which will drive ultimately the Fed raising rates. That linkage really hasn't existed throughout this economic cycle. Growth expectations from the Fed have been extremely generous over the years, and the Fed finally kind of said, threw their hands up and were essentially changing their tune to a more dovish stance. And so, we saw the average expectation for rate increases go from 2 from the FOMC down to 0 for this year. We saw the expectation for next year to be about 1 rate hike, which was a revision lower as well. And essentially a lot of commentary from Jay Powell just saying that we're here to be patient, and this is kind of a new phase of this economic cycle.
And I think it's interesting when you said the linkage is maybe not there currently. Perhaps some of that has to do with baby boomers retiring and the millennials taking their place, and the millennials are coming in at a lower wage scale, not necessarily a low wage scale, but certainly lower than what the baby boomers were going out at.
Yeah, for sure. This labor market has definitely been, troubling and confusing for a lot of economists because, again, like you said, a lot of baby boomers have delayed retirement. Those who have retired are being replaced by lower wage, millennials, and as a result, we just haven't seen the wage pressures that you would typically expect with the unemployment rate so low. So I think I know growth expectations were also revised a bit lower. Inflation, expectations for this year came in around 1.8, GDP growth around 2.1, which is a notch lower from what was expected. And that's the other piece is there's been a lot of deflationary forces globally. It's just not translated in inflation. Expectations for such a low unemployment rate as we would expect.
And I think last year we had a real strong cycle with the tax cuts driving some growth upward. Middle part of last year, everything was rolling. I mean, the economy was rolling, manufacturing, services. And late in the year, it seemed to slow down just a little bit and maybe, again, get off to a slow start this year.
Yeah, this might be the hangover from, all this fiscal stimulus from tax reform that really started to take hold right at the end of 2017 when it was announced. Early 2018, it seemed like we shot out of the gate from a growth perspective. And as the year went on, things, started to look a little less positive, and the economy, not just here in the U.S., but around the globe, started to slow down a bit. And so, again, it's just some of those one-off effects bleeding off, and now we're back to this reality, which is an economy that's going to grow a lot more slowly than what you would expect during an economic cycle of 3.5% GDP growth.
And I think context is really everything here, because if we go back and say, well, we're only growing at 2.1%, some people might say that's terrible, but relative to a 3% growth rate middle of last year, that might seem slow, but relative to a long sustained 10-year pattern, 2.1 is actually the pattern, and it's quite good.
Yeah, it's just the new normal, and the economy doesn't have population growth because the millennial generation is not really in its peak household formation years. Population growth hasn't been significant from people immigrating here. And then technological advancements, as much as it's nice to have an iPhone in 1.4 billion people's pockets, It hasn't translated in productivity gains. So all that is leading us to grow lower for longer. And so even though we are seeing growth accelerate from the higher levels that we saw in 2018, this is kind of a normal growth environment for this economy at this stage.
And perhaps if we can grow longer at a more sustained pace, we can also keep that inflation lid, and then the Fed doesn't have to raise rates and choke things off and almost always bring about a recession as a result.
Exactly.
Speaking of that, then Friday, transitioning from the Fed to what happened with interest rates on Friday, we had a yield curve inversion, the classic 210 as they sometimes call it. We've had some inversions late last year, but this was the one that seemed to send the media and the markets into a frenzy on Friday. Tell us more about what happened.
Yeah, so just, for educational purposes, the yield curve is taking a look at treasuries or bonds, issued by our government and looking over, their tenor from, the shortest being just a couple of months and the longest being 30 years, and where the yields of those bonds or notes stack up versus one another. And so in a typical a typical growth period, the yield curve usually looks fairly steep, and that growth expectations and inflation expectations are higher years down the road than they are right now, and things are accelerating. And when you get late into an economic cycle, you start to see the yield curve flatten and then almost always invert prior to that next recession, because the growth and inflation expectations moderate and are no longer as high as they are right now, essentially. And so that's essentially what happened. I would say no modern day recession has ever occurred without a yield curve inversion preceding it. But there have been several instances in the past where the yield curve has inverted, like it did in 1998, like it did in 1965 and 66. The Fed cut interest rates and the economy continued to chug along, for several more years. So I think that's kind of the positive to take a look at as we put it in context of this really weak economic growth trajectory. This has not been a typical economic expansion, and therefore it may not be a typical yield curve inverts and 2 years later we get a recession sort of situation.
And you just said that word context again, and I think that is so important to look at, because in this current yield curve inversion, it's not like 1980 where the Fed was raising interest rates to 18% to break the back of inflation. I mean, the yield curve inverted then because the Fed wanted to invert the yield curve. I don't think they're trying to invert the yield curve. This is more of a market-driven dynamic. And frankly, the yield curve has been fairly flat for the better part of 2 to 3 years now, not only domestically but overseas. And speaking of which, I saw some data pointed out that overseas, the yield curve inversion does not have any correlation whatsoever to predicting a recession. So perhaps in America we talk ourselves into this.
Yeah, definitely. I think that's a really interesting point that, outside the U.S., the yield curve inversion hasn't necessarily meant what it historically has here in the U.S. And as we grow more slowly as a country, we start more closely resembling some of those non-U.S., particularly European countries, where the yield curve hasn't necessarily translated into a recession. I think the last piece, I just want to make is, when you look at the supply and demand of treasuries, issuance has been very high. We have this deficit. However, demand has been extremely high because, to your point, when you look outside the U.S., rates are extremely low, if not negative, for a lot of the developed countries around the globe. And so there's been a tremendous amount of demand coming in from the Japanese pension fund that's trying to meet pensioner obligations, where it can't get any yield whatsoever that's positive going out 10 years for their own economy or for their own, in their own bond market, but they can come here to the U.S., experience an appreciating dollar, and now pick up, 3% on the 30-year. That's an investment that's being made, and it's going to drive the rates lower, probably artificially, than what would be if that didn't exist.
So it's really a win on two fronts. They capture yield, plus they potentially capture currency appreciation.
Exactly.
So, well, thank you very much, Tim. It's a good update. And thank you very much for joining us for this month's edition of Girard's Monthly Market Update. We look forward to seeing you again next month.